Good evening, everyone. I'm Verity from Monsoon Communications. Thank you for joining us for CLINUVEL's annual results briefing for the 2022 financial year. I'll now hand over to Malcolm Bull to begin the presentation.
Thank you, Verity, and thank you for organising the briefing for us. Welcome to everyone joining us online for the investor briefing, as Verity said, on CLINUVEL's financial results for the year ended 30 June 2022. I'm Malcolm Bull, Head of Australian Operations and Investor Relations, and today I am joined by our Managing Director, Dr Philippe Wolgen, and Chief Financial Officer, Darren Keamy. Today's briefing will revolve around the results for the financial year 2022, the key activities of the year, as well as ongoing initiatives to bring the company's objectives to positive outcomes. Throughout the meeting, we will answer questions relating to our financial results, and at the end, time permitting, some recurring questions on other topics. Now, before we begin, let's observe our forward-looking statement, which highlights that we may possibly talk about future plans, and investors need to be aware of the varying risks that can arise, affecting the realisation of planned outcomes. Now, a copy of this statement is available on the company's website. To start, I'll hand across to our CFO, Darren Keamy, for the financial highlights.
Thanks, Malcolm. Hello, everyone. It's a true pleasure to summarise the excellent financial outcomes of the group's operations for the financial year ended 30th of June 2022. Investors should note that the figures we refer to are in Australian dollars, and for most of these, they are rounded for ease of reference, and changes in comparison to the prior year are provided. So to summarise, compared to the prior year, total revenues has risen 37% to $65.7 million, including interest and other income was $67 million. Total expenses rose 44% to $32.7 million. Net profit before tax rose 33% to $34.3 million. And net profit after tax fell 16% to $20.9 million. So this is the sixth consecutive annual profit since the commencement of commercial operations back in June 2016. There has been positive overall growth across the group's activities, increase in internal investments, and a year-on-year increase in headcount of up to 16%. Net assets have increased by 27.2% to $125.6 million, with the key change of the balance sheet being a substantial rise in the cash balances, up 38.8 million to 121.5 million through the course of the financial year. Two other key measures of performance to mention is our return of equity, which is at 17%, and our earnings per share of 42.3 Australian cents. So to cap these results, we are now in the position to think about our shareholders even more, and we are declaring for the fifth consecutive annual dividend, which is a 60% increase from 2.5 cents last year to 4 cents on current year earnings.
Thanks, Darren. You've got to say they are welcome figures, and you and Paul Lim and the finance team must feel pleased about the delivery this year. To go beyond the highlights, Darren, can you give us more depth to the growth of revenues and expenses and profit, as well as the context of the past 6 years of commercial operations? Or in other words, on behalf of investors, how should they look at these financials in the context of markets and our sector?
Well, for start of revenues, we've worked towards continuing positive annual growth over 6 years of being commercial. So to put context to our growth curve, since we've entered the US, we've achieved an increase in our total revenues of 37% in the current year, and that was on the back of a 47% increase in the prior financial year.
Right.
So this path reflects increased patients treated, more physicians are prescribing, more patients are being retained. Above all, we're creating more efficiency through the work of our CLINUVEL teams, who are proactively supporting the distribution by collaborating with the physicians, with insurers, with training and liaising with the accredited centres and with the patients. So, what we're doing is that by being closer to our value chain, the better our results are proving to be.
Right.
Now that's on the revenue side. From the expenses sides, our expenses can fluctuate depending on the start of certain key activities, but overall, they have increased over the past 3 financial years in a very controlled and deliberate manner. So the growth in expenses in 2020 was 49%. It was more in a controlled fashion in 2021 of a 2% growth, and then a further 44% growth in the current year. And this is on the back of supporting the growth initiatives within the group. So it goes without saying that the longer term positive trend in our growth and revenues has allowed us to ramp up our expenses, and that is driving us forward into new R&D, into our product development, and into new markets. Now, as to reporting the profitability of the company this year, in our annual report, we've made a distinction between 3 measures: net profit before tax, net profit after tax, and we've provided a non-IFRS adjusted net profit, since in the end what matters is what expenses directly are affecting our cash position. And since some material expense items are charged to meet accounting requirements that do not affect cash. So the profit before tax figure has risen strongly in the current year, and whilst the impact of non-cash expenses as well as income taxes payable have reduced the net profit after taxes, nonetheless, it's a much desired result that we've lodged in for a life sciences company, not only in Australia, but also in the US and for other markets. So I'll speak later somewhat more about the NPAT and on the non-IFRS adjusted results to see how the expense items have affected our net position.
Okay, yes, certainly we'll return to the financials, but some participants have asked for a summary of operational objectives fulfilled throughout the financial year 2022. So I'd like to invite our Managing Director now, Philippe Wolgen, to say a few words on the past year.
Certainly, thanks, Darren Markham. The results that Darren has summarized for the group are the outcome of a longer-term strategy, very much based on the integration of the business functions and the model we started years ago. And as a business, you wish to build in operating procedures at each level of the divisions, while being sufficiently flexible to change course if and when required. Now, for the financial year 22, we were able to expand more on R&D initiatives, enhance our melanocortin portfolio with NEURACTHEL and the ACTH analog, and start a DNA repair program evaluating afamelanotide and xeroderma pigmentosum with the 3 ongoing studies, and complete the first stroke study CV801. We manufactured the first pilot batch of the OTC product lines, and we brought in more specialized talent, 16% in total, and established a CBM, a communication, branding, and marketing team mandated to build larger audiences for the group. So we've been fortunate in managing the supply in the midst of the global economic geopolitical disruptions, while overcoming the pricing pressures from insurers, as witnessed by the agreement reached with one of the most prominent EU reference countries, Germany. So if I had to summarize in 4 the key activities of financial year 22, have been focused on the ongoing distribution of SNES, the development of the melanocortin drug portfolio, the progress of the expanded clinical program, and the ongoing development of the non-pharmaceutical, the consumer health products, preparing for the first product launch. Now, for the longer-term shareholders, you've gradually seen a shift from a mono-focused team inching to one diversifying its activities. And my main concern in spreading our wings is still for our teams to maintain the focus required to record meaningful progress. Now, for this to occur, we substantially increased our headcount in 22. I think most relevant to today's discussion are commercial efforts translating into financial results. We saw increased patient access in the European Union, US, and Israel. We reached a milestone 5-year agreement with the Joint Federal Committee in Germany, the state and private insurers, and therefore we continued the reimbursement in Germany. That there was a hard-fought battle over 16 months. We expanded the melanocortin drug portfolio by adding an ACTH analog and introduced NEURACTHEL. We continued the development of Penumbra Instant, which we recently announced will be the first in the clinic for the next stroke study CV803, and we secured exclusive manufacturing for this. We started 3 studies in DNA repair centered around xeroderma pigmentosum, a horrific genetic disease, and CV151 serves as a control study in non-diseased populations. We completed, and released the positive results of 801, a study in arterial stroke, and we reached an accord with the FDA with a way forward to start a monotherapy in vitiligo in darker skin populations. And we also progressed the work on the OTC product line. So they're getting quite close to the launch.
Well, thank you, Philippe. What a list of activities and achievements. And I know in my role as head of Australian operations, interacting daily with the teams worldwide, it's clear that the group, the past year, has ramped up its activities on many fronts. It's good to see. And these broader and simultaneous activities are very, very different from company I joined 3.5 years ago. Darren, back to you. Let's get back into the financial results. And we've received a number of questions on the difference between the net profit before tax, net profit after tax, and the non-IFRS outcomes. So can you shed light on these and walk us through the differences?
Yes, I can. So first you can see the differences on the graph between the net profit before tax and the net profit after tax results over the 6 years of commercial operations, and the divergence between the two profit measures that have widened in recent years. So broadly speaking, the company was able to benefit from setting off the tax losses that it had accumulated in those years prior to commercialising SCENESSE against the first 5 years of profits being recorded. So this has resulted in some negligible past tax obligations, but it had afforded us to recognise income tax benefits in the income statement, which occurred upon recognising a tax asset on the balance sheet. So in the past years, we saw the before tax result and the after tax result to be quite similar, and even in some reporting periods, a higher impact result relative to the before tax result due to recognising an income tax benefit.
Right.
During the course of the year, those usable tax losses were consumed and the company's deferred tax assets were reduced as a result. So this has contributed to a deferred tax expense for the year of $6.2 million. So in addition to this adjustment, current tax for the year and payable in the next year was reported at 7.4 million Australian dollars. Also relevant for the group and also for myself as CFO is to understand the impact of certain expenses, particularly those of a material nature, and whether they impact the group's cash position. So one of these charges is the expensing of performance rights, being prospective equity instruments that are issued for staff who earn over a vesting period of up to 4 years. These instruments are valued in accordance with accounting standards, but they don't impact cash. Hence, by removing certain material non-cash items from the statutory reported after-tax result, we arrive at a non-IFRS adjusted profitability measure of approximately $27 million. Compared that same measure to the prior year, we are nearly equal. So going forward, we do intend to continue highlighting certain expenses charged and the effect that these material non-cash items may impact on profit, because sometimes this impact can be confusing for shareholders.
Okay, thanks, Darren. I think that clarifies and does answer some important questions. And as you mentioned, Darren, expenses have increased significantly over the past 3 years. So can you comment on where the expenses are being incurred?
Yeah, the increase in our overall expenses is very deliberate and very controlled. We're clear on that in our communications, and it is to support the growth of the company. And as Philippe has already provided an overview of the diversity of the group's activities to which these expenses are applied to. So to give an overview of the increases in the current year, our largest expense category is personnel, and that did increase 14.1% in the current year. As we did indicate in the annual report, the year-on-year increase in the number of employees of the group was 16% from start to end, and an average headcount of 13% increase. So that broadly reflects the increase in the personnel costs. We also experienced a hike of 48% in materials and related expenses, and some of these do reflect marked up activities, you know, within the inflationary environment that we find ourselves in. Thirdly, non-cash items disclosed in the income statement and aggregated together, such as depreciation, share-based payments, and unrealised movements in foreign currency balances. Combined, they rose 42% in the current year. And combined, you know, it does equate to our second largest expense category for the year. And lastly, other expenses, once again combined, being our administration, legal and marketing functions, they also increased 23% year on year.
Okay, and a useful graph on screen, or was on screen, to track those categories. Perhaps I can go back to you, Philippe.
Sure.
We had projected a positive trend in expenses over the 5 years to 30 June 2025 to support the growth and expansion of the group. So can you comment on these, please?
Yeah, so you're likely alluding to the projected expenses and the expenses recorded during the financial year 22, and whether these fit the overall targeted results.
Correct.
As we started, as stated in 21, to achieve a number of value-added objectives for 5 years, both the board and management laid out a plan costing out cumulative expenses of 175 million over the 5 years ending 30th of June 25. Now, at the end of this trajectory, that's important to note, a number of key objectives would need to be fulfilled. In essence, the regulatory approval of SCENESS in an additional indication, the launch of a new Rectel, several consumer health products, and other R&D projects engendering further value. So if one adds the total expenses over the last 2 years, one arrives at a total of 55.5 million, and that leaves 119 million to be expended over the next 3 financial years. So we are nigh on course adhering to our 5-year plan.
Right. Look, just for an investor, can you clarify that these expenditures are operational in nature and do not include CapEx?
Yeah, that's correct. Yeah.
Okay. So Darren, let's look into the balance sheet, and an obvious observation is that our assets have increased over the last 6 years, and in absolute terms, tower over our liabilities. For you to comment.
Yeah, that's right. That's a deliberate strategy that reflects the approach we have to the business in general, and the strength of the company in particular. So, as can be seen, the balance sheet is extremely strong. We have no debt and high liquidity due to the accumulated cash reserves. So our liabilities are largely comprised solely of trade payables and short-term tax obligations. So the net cash generated during the years bolstered our cash reserves significantly, and the rate of increase in our cash reserves is particularly noticeable in the current year when compared to prior years.
Well, yes, that's a great gradient to have in your favour. Philippe, we covered the deployment of these accumulated cash reserves in the last news communique number 4 for the calendar year, but we do continue to receive questions on our approach here. Do you have more to say as to the cash reserves being built and how they're going to be used? Sure,
plenty to say, but I think we can state our approach often enough in the interest of all shareholders. R&D by pharmaceutical companies would be well off in carrying sufficient cash to operate 2 to 3 years without leaving shareholders and markets second guessing as to when a company needs to raise funds, either debt or equity. And the overhang of further funding required depresses notional value, introduces uncertainty among investors. Yet as a reasonably successful commercial company, CLINUVEL returned in 22 to increasing its R&D expenses to drive a pipeline for future accretive value. And this R&D was projected to be financed by the cash, or the company's own cash reserves, and the future proceeds from our operations. Now, second, a margin of cash is needed to withstand economic downturns and what I call Six Sigma events. And those force majeure events are notionally the ones that we never see coming, but actually take place more often than one projects. And it's part of CLINUVEL's risk management to control its finance and maintain a liquidity ratio. Now, with this particular approach, all shareholders have benefited from a going concern, not being re-rated by our auditors, and not being forced to raise further equity in uncertain markets at deep discount. The third, cash, allows for redistribution of a percentage of the profits to our shareholders. And of our net profits this year, we redistribute 10% to our shareholders. And that is without jeopardizing or impacting our plans. And from a personal perspective, 35% of our shareholders consist of family offices, retail investors, institutions who willingly have chosen to stay more than 15 years in CLINUVEL. And for those who supported us, I believe dividend strongly communicates and sends a message of appreciation, since it remains rare for a biopharmaceutical company to do so. So as Darren mentioned, the board declared a 60% increase in the dividend this year in relation to last year. So it's excellent.
Okay, so look, for me to summarize our discussions to this point, we have seen a 6th consecutive annual profit, reflecting strong demand for SCENESSE, and established a viable track record as a first-in-class drug therapy. This is the outcome of a long-term disciplined strategy and the deployment of an integrated business model. The returns to shareholders are sound. We currently have strong foundations to allow growth and are amongst a very few biopharmaceuticals, as Dr. Wolgen was saying, in Australia or the US to post profits year on year. We focused on particularly the safety of SCENESSE to allow translation of its use in wider audiences. The group's financial management allows for diversification, redistribution, and security, benefiting all shareholders, patients, and their families. The group's ongoing activities are focused on the growth in the distribution of SCENESSE, the building of regulatory dossiers to expand use, and the launch of the first polychromatic dermatocosmetic product. And you may see some announcements on readouts of study results when available, and clinical programs in general as they commence and progress. Now, in the time we have left, I'd like to turn to some non-finance questions, noting there will be further opportunity for questions at the annual general meeting. So Philippe, first we have a few questions on SCENESSE for EPP. First, what is our market penetration and is demand likely to level off?
Well, the growth we're experiencing, particularly in the US, is well beyond our own expectations and projections. The penetration of the EPP market is set by independent analysts to be relatively low. It's 2 to 3%. In general, we've never commented on penetration of the EPP market, but there is a consensus that there's ample room to grow, and we're not foreseeing a plateau soon.
Okay, all right. Another area of investor focus is possible competition. Can you address this, please?
Yeah, well, we've addressed this on more than one occasion in the public.
Yes.
CLINUVEL is a pioneer in photomedicine in having developed the first systemic photoprotective therapy. And of course, there will be competition. We've always foreseen that in the fields that we explore and pioneer, and that will attract others. But this is not a winner-takes-all scenario, as one of the uninformed commentators recently stated. These statements should be contrasted with the assessment of one of the most revered independent analysts of CLINUVEL with the lengthy experience as a physician, to understand that there is room for more than one therapy in EPP, and that is should a competitive situation arise. Now, CLINUVEL will compete, but we're certainly not about to telegraph to the world and our competitors our plans in answering maybe a well-intentioned question. Let's not be naive. The competition is about strategy and tactics, and we will guard our competitive armor and firepower until it needs to be used.
Okay, thanks. Turning to healthcare solutions, the rationale is to translate our expertise in pharmaceutical drug development and photomedicine and regeneration of the skin damaged by exposure to light to audiences in the general population, which are currently underserved by existing dermatocosmetic products. So, Philippe, who are the targeted audiences?
Well, that's a broader topic. I'm happy to talk about this in the upcoming strategic update 5 on the 17th and the 18th of September. And we will spend much time on communicating the why, the how, and the when. So I'll leave it to them.
Okay, that's good forward advice of to look out for those, to look out for the update. Look, at this time, I think we need to conclude the investor briefing with thanks to Darren and Philippe for their informative comments and answers to questions.
Thanks, Mel. Thanks very much.
You're welcome.
Thank you there, Malcolm, for hosting this.
No, it's always my pleasure. And I wish to thank all shareholders attending the briefing and for sending in questions. We do appreciate your support throughout the year and long term, and we trust you appreciate the dividend increase coming your way. Our appreciation is also extended to the independent analysts on the phone and who have provided new reports on the company during the past year. And you can look for a transcript of this investor briefing to be released to the Australian Securities Exchange for all stakeholders to read at their convenience. Now, the next key shareholder events are the Strategic Update 5, as Philippe mentioned, in September, and the Annual General Meeting 2022, which will be held late October in Melbourne. Now, this will be an in-person meeting and provide an opportunity for shareholders to also dial in and view the meeting. We wish you all good health and progress in your individual objectives, and thank you again for your support of CLINUVEL. Thank you.
Thank you.
Thank you.